Last panel of the day. Hope everybody is fully caffeinated. Welcome. My name is Peter Frumhoff. I'm at the Union of Concerned Scientists, and I'm delighted to moderate this session. We have a terrific set of panelists. We have one program change from those of you who've been looking at the written program. Our colleague Geoffrey Supran, who was intended to give a talk during this session, had to step away unexpectedly yesterday and was unable to join us today. I'm going to crib a couple of his opening slides to make some of my opening remarks. And Ben Franta at Stanford University has kindly offered to step in and speak to the core points of Geoffrey's talk. So thank you very much, Ben, for joining us today. I'll introduce the panelists in just a moment, but I just wanted to tee up this session on well below 2 degrees reporting by major fossil energy companies, the good, the bad, and the very ugly. There are now, since Paris, a host of reports that investor-owned fossil energy companies are producing around climate. Some of them as the result of pressure from investors, in particular, for example, the 2-degree report from ExxonMobil came reluctantly, as ExxonMobil was essentially forced to do so by a shareholder resolution a year and a half ago or so. Others willingly, some very specific to the question of, or at least as they perceive it, to the question of the 2-degree target in Paris. Others broader or slightly different frames around climate and climate resilience and the question of how the company thinks about climate change in this post-Paris world. So some differences between US and European companies that we may dig into in the context of this discussion, but there are a lot of reports out there. And there are also now, not surprisingly, a number of assessments of these reports, and they also, and this comes from Geoffrey's thinking, Geoffrey Supran's thinking, they kind of break into a couple of different categories. There are some fairly high-level assessments of general investor principles by which companies might need to report, for example, on climate generally or on their 2-degree target activities specifically. There are some top-line assessments, often kind of using a checkbox kind of set of metrics comparing companies in their reporting on their 2-degree targets, including a piece that Kathy Mulvey will be speaking to today. And then there are some much more granular assessments that dig in some detail through a range of lenses to specific reports by companies. ExxonMobil's report, for example, has been the subject of several assessments and in some cases some detailed comparisons across a range of metrics of companies by a number of actors, mostly people looking at this through a financial risk lens, which is really what the goal was as framed, for example, by the Task Force on Climate-Related Financial Disclosures. We have today on this panel a really interesting set of actors to take stock of both where the company reports are, particularly with respect to the focus on company compliance with the targets identified in the Paris Climate Agreement, including from a range of really interesting and diverse perspectives. I'm just going to quickly name our panelists. We have Sophie Marjanac, who'll be speaking from ClientEarth, looking at these reports from a legal perspective. We have Joe Alexander, who's at ShareAction, looking at company reports from an investor, activist investor perspective, but also, I might add, from a very interesting background. Joe has recently come to ShareAction after a history of work as a petroleum geologist at BP, doing oil exploration, so brings a unique combination of expertise and perspective to this conversation. Ben will speak from kind of a social science and history of science perspective to the work that Geoffrey has put forward, looking at a range of metrics comparing company reports to their other ways of communicating about climate change in other domains. Myles, who many of you may know, in his spare time when he's not writing IPCC reports or doing climate modeling, has also been spending some time thinking about investor principles for investing in companies through the lens of the temperature targets of the Paris Agreement. And Kathy Mulvey at the Union of Concerned Scientists will also be speaking from a kind of an activist and shareholder perspective as well on company accountability in light of their 2C reports. I just want to, before I turn it over to our first panelist, I just want to make one observation. One of the reports that was listed up there was from the good folks at As You Sow. And I just wanted to note that they had a figure in their paper which characterized that there are something like 160 climate change shareholder resolutions that have been filed at 24 US oil and gas companies between 2012 and 2018. Some of them, particularly obviously post the Paris Agreement, and the ones in black, which are about carbon risk, have focused on the 2-degree target. But they've covered a range of areas of focus around climate and company responsibility. And they had an interesting observation, which I just wanted to share with you as a kind of tee-up to this panel. In the summary of their report, they said these resolutions have resulted in a range of successes, from appointing climate-competent board members, including at Exxon, to reducing some operational greenhouse gas emissions. But despite this movement, none of the US oil and gas companies have adopted plans or targets to limit their full life cycle contribution of greenhouse gases. And in that light, let's see if I can scroll this down, maybe I can't. I actually don't have the specific points, but they basically made the point, I can pull this up, that there's been no material progress in reducing emissions that matter most, particularly the product-related Scope 3 emissions that Rakiti was speaking about in the session this afternoon here, in alignment with the Paris Climate Accord, that these emissions, because of their size and scale, are the most relevant proxy for assessing company progress on climate change goals. And the fact that global greenhouse gas emissions and oil and gas company capital expenditures on exploration and production keep rising signals a fundamental limitation, they would argue, in the current shareholder engagement strategy. And they make the case that shareholders must grapple head-on with the implications of an oil and gas business model that continues to invest unabated in products which, when used, run counter to meeting the temperature targets of the Paris Agreement. So I just want to put that out there as one frame of reference. We'll look at a range of other frames of reference, both in terms of, again, what companies are currently doing, what they need to be doing, and what are the levers we might pull in order to get them from where they are today to where we might think they need to be. So with that, let me turn it over to Sophie as the first panelist, and we'll just go through each panelist in turn before we open it up for questions.
I suppose to frame the discussion this afternoon going forward, I thought it could be useful to begin by setting out the types and range of corporate reporting on climate change that one now sees, and to perhaps categorize the range of different reports that are now coming out of oil and gas companies, and particularly in the past few years as a result of shareholder and public pressure. The quantity of corporate reporting on climate change has dramatically increased, as Peter's just mentioned. But there can be sort of some confusion about what all of these documents are about, who they're for, why they're being produced, and what they say, and what the law has to do with all of that. How is the law relevant? And so in this slide, I've just tried to capture the range of different documents that are coming out of the oil and gas majors. And you'll see the very small inner square there is essentially the legal requirement. So the requirement in the UK, the Companies Act, and in the US Securities and Exchange regulation and legislation. So essentially, I wanted to really come back to the question, what is the purpose of corporate reporting? Why does a company do an annual report? So in the UK and now globally, where there's broadly standardized reporting requirements, there are a narrative report and of course the financials. And the purpose of the financial report is, under the accounting standards, to give a true and fair view of the assets and liabilities of the company at the time of the report, and for the company to produce its results. So whether it's made, lost money, how much in dividends it's paying out to shareholders, etc. So from the accounting perspective, the objective is to provide a true and fair view to investors. Legally, in the UK, the purpose of the annual report is not to induce anyone in the public to enter into or to buy those shares. So there's a legal decision called Caparo, which found that the audit firm doesn't have a duty of care to any purchasers of shares, and that said that the purpose of the annual report is for the company to tell shareholders how it's performed over the past 12 months. Now, we know that shareholders do rely on that information. We also know that they don't even look, well, they do to some extent, but they don't look greatly at the financials, because the value of the company, as shown in the financial annual report, is entirely different and separate from the share value. And so the share price value now really has become the proxy for how investors value the company. But all the information that's produced together with the annual report is still examined in great detail by investors. And it's clear that it plays not only that strictly legal role, but it plays a broader role as well for the company in society by establishing its license to operate, by informing the public about how the company is, and investors, how the company is responding to risks in its industry, and essentially setting out the company's strategic direction going forward. So it does inform the share price, but of course, bearing in mind that the share price is separate and based on investor sentiment and not what's in the actual financial annual report. So in the UK, the legislative requirement is quite short. And in terms of corporate reporting for climate change risks, what companies are required to report on is in the management report, so this is a European requirement, they need to report on the principal risks and uncertainties facing their business and the main trends and factors likely to influence that business in the coming 12 months. So the management report, it's also called the strategic report in the UK, and it's meant to tell investors how the board is performing its duty, its statutory duty in Section 172 of the Companies Act to manage the company in the best interests of its shareholders, taking into account stakeholders. So the actual legal requirement for narrative reporting is quite limited. Nevertheless, at ClientEarth in 2016, we argued that, and in fact, I analysed those provisions and found that there was not enough information about climate change in the corporate reports of a number of companies. Essentially, our interpretation of those sections, principal risks and uncertainties and main trends and factors, we found that climate change ought to have been considered, and we've now, in fact, reported and had 3 suites of corporate complaints to the Financial Reporting Council in the UK. The first set was in respect of oil and gas companies in 2016, as I mentioned. Then just a few months ago, we reported 3 insurance companies for failing to adequately comply with the legal requirement in the Act. And then again, last week, we reported EasyJet, Bodycote, Balfour Beatty, and Enquest for their failure to include climate change in the management report of their 2017 annual reports. We also then wrote to their auditors, the big 4 audit firms who have a corresponding legal duty to ensure that what's presented to the public is relevant. So the relevant test in both, and so the large circle around the strict legal requirement is the TCFD. So of course we know that the TCFD grew out of the Bank of England's 2015 report. We know that that report identified physical transition and liability risks for a range of companies and recommended that companies disclose a far broader suite of information than in fact they are legally required to do. But the same test was applied, and that is a materiality test. So is it material to the financial interests of the company? And that is something that traditionally regulators have not been willing to judge on and to make much comment on, and that's because it's seen as something that's within the board's capacity to determine what's material, financially material to that company. So the materiality assessment is quite difficult and has been difficult in some of the TCFD's in implementing the TCFD and in thinking about these issues. But so both of those reporting, let's say, suite of information that might come out of a company. So you've got the annual report there, and then you've got this broader set of TCFD. And I'd say that with the TCFD, although no country has actually implemented the TCFD into its legal requirement, what the work around the TCFD is doing, and the reason why it's important, is that it's creating a norm and it's creating a market standard, and it will become then in the future, the legal test around what is reasonable and what is reasonable reporting will change. So we're building norms through encouraging the TCFD's disclosure. I'll also note Australian Securities and Investment Commission just recently, last week, put out some really great guidance that talked about TCFD implementation. There's a lot of pressure on the International Organisation of Securities Commissioners to adopt the TCFD as minimum standard and best practice. And so we see, in the same way that the Modern Slavery Act then was translated into, this sort of voluntary reporting requirement was translated into legislation, potentially that could be the direction of travel for the TCFD as well. And then, of course, we have sustainability reports, which do overlap to some extent with the legal requirements and the TCFD, and then the above 2 degree scenarios, so the energy outlooks. And that's really the company's way of attempting to influence the future by putting out its view of what the future is. So my time is brief, so I'll excuse me. Flip to the next slide, which I will share. And this really sets out the third category and breaks down the third category of litigation risk for large fossil fuel producers. So that's breaking down the third category of the Bank of England's category of risks. And I'd just like to note that these are all quite different, obviously, but the one that we tend to think of is this one at the top. So these tort claims that are directly being brought against producers for their historic emissions. But in fact, there's a whole suite of other litigation risks and causes of action that arise, and perhaps may arise before these really challenging tort claims, such as those being brought by New York City and San Francisco in the US, have success. There's also a range of cases that arise from failure to manage physical and transition risks that could lead to losses. And so we're seeing that play out in the Gulf after Hurricane Maria, Irma, and Harvey. There were huge losses by a lot of oil refiners there, and there will be litigation arising from that. So that's just litigation that arises as a result of natural disasters and physical risks. But really important for today's discussion is reporting of climate risk and liability risk around reporting. And this perhaps is an underappreciated risk for the companies, because of course, as all of this new information comes out, and my previous slide, we've seen that there are a number of different reports. As Peter said, they all have slightly different audiences in mind. And it's important to note that especially in the US, there's a really strong regime that protects consumers and shareholders from fraudulent corporate disclosure. And a really important case I'd just like to touch on is the case of Ramirez and ExxonMobil. So just recently in Texas, about a month ago now, a shareholder class action has been permitted to proceed to trial. So they have gotten over the initial hurdle of litigation. And the judge found that there was sufficient fraudulent intent on behalf of various executives of ExxonMobil in relation to their climate change disclosures. And that was because the company had said that it applied a proxy cost of carbon of $80 per tonne, when in fact it actually applied a $40 proxy case in some circumstances, but not all. And they also found that the company debooked a lot of reserves. I think you may recall that in 2016, Exxon debooked reserves, which were really highly significant. There was a gradual decline in the share price, and the investors are now claiming that debooking should have been done earlier at the time when the executives became aware of it. So it's a really important claim, and one I think to bear in mind going forward, that the law will not always necessarily prescribe a whole set of specific and detailed disclosure obligations, but what it will do is intervene where the disclosure has been misleading or fraudulent. So really important in examining perhaps these different disclosures to pick up on the inconsistencies between those. Where a company has used a self-serving assumption in one scenario for perhaps its energy outlook versus another assumption in its sustainability report for a different audience, that's the kind of thing that can be used as evidence of misleading conduct in the disclosure of climate change matters. And I'll leave that thought with you. Thanks very much.
Hi. It's a pleasure to be talking with you today. Hope you can hear me. Great. So I'm Jo Alexander. I work at ShareAction. I've been at ShareAction for a couple of months, so I'm actually representing the work of many other people, particularly my colleague Jeanne Martin. So ShareAction works on the investment system to make it a force for good. That's what we exist to do. So we try and unlock the investment system, its positive potential to influence corporate behavior, and particularly create a movement of people inside and outside the investment system to challenge the status quo. So that's kind of the official line of what we do. So today I'm going to just tell you a story about some shareholder resolutions that ShareAction has been involved in, picking up particularly on two shareholder resolutions, some that happened in 2015 and one that happened this year in 2018. So AGM activism is one of the tactics that ShareAction uses. There are lots of others. And in 2015, ShareAction and ClientEarth supported the Aiming for A resolution brought forward at the Shell and BP AGMs. And that resolution requested a disclosure of additional information on climate-related issues over 5 areas. So it was the resilience of their portfolios to the IEA scenarios, also requesting them to disclose their operational emissions, carbon intensity of their emissions, really covering scope 1 and 2. What they're investing in low carbon equivalents to oil and gas and R&D, relevant KPIs and how they measure success and how their executives are compensated, and also their public policy positions. So it was asking for quite a lot of disclosure. And both of those resolutions at Shell and BP passed with over 98% of the vote, which was a really landmark resolution. And when you look at some of the history of AGM resolutions, sometimes on the climate resolutions, you're lucky if you get a few percent. So this was an enormous moment in AGM activism and how influential it could be. I think the success of it was to do with all of the work that happened beforehand and the large group of institutional investors and groups that came together. And that put pressure on the companies, BP and Shell, to agree and recommend that shareholders voted for the resolution, which is very unusual. Most climate resolutions at AGMs, the management will suggest that shareholders vote against them in really all cases I've heard of. Except this. So it really was a landmark moment and very successful. So as a result of that, there have been some interesting disclosures from BP and Shell. BP this year will be investing $500 million in low carbon investments, and Shell says it will invest up to $2 billion by 2020. Shell, as we know, and we've seen earlier today, has set some targets for decreasing their carbon emissions, scope 1, 2, and 3, so including the emissions burnt from their products. It's a bit and so those targets are, cutting by 20% by 2035 and 50% by 2050. So all of these things that I've just mentioned, the particular disclosures, they don't really get us far enough. The CapEx expenditure on low carbon technologies is dwarfed by the capital expenditure they make in exploration and production in the kind of core of their business. And then not talking about kind of hitting any kind of carbon neutral trajectories at all. So really asking for disclosure is brilliant because it puts the subject on the table, it gets the conversation going, investors can talk to companies about how important this is to them, but you can have fantastic disclosure as a company and really not be doing anything to try and meet the goals of Paris. So disclosure is really not enough, and we really need to move into action. So now I'll go on and talk about the 2018 resolution at Shell. So this was a resolution brought forward by Follow This, which is an NGO investor group in Holland. We, ShareAction, co-filed that resolution. And this was much more action-oriented. They asked the company Shell to set emissions targets, emissions reduction targets. And the concern was that what they talked about in terms of reducing emissions, they talk about it in terms of an ambition, which is very different from talking about a target. So it sounds like a nice to have when you say an ambition, but a target is much more specific, time-bound, measurable, something you can hold them to account on. So unfortunately, that resolution, it didn't go as well. It did get some really good support. However, only 5% shareholders voted in favour of that resolution and 7% abstained. Obviously, management suggested that shareholders didn't support the resolution. So actually getting action on some of these resolutions, in addition to disclosure, is quite difficult, but it's something that ShareAction continues to work on. I also wanted to talk about how institutional investors are behaving, and a report that ShareAction put together looking at their voting from 2016 to 17. So we see this as quite an important turning point in the way that institutional investors are behaving, and seeing an increase of support for climate resolutions. So this is just looking at 7 of the top highest carbon emitting companies in the US and how the overall voting changed between 2016, which I think is in the blue, and 2017, which is in the orange. And in all cases, it increased. I mean, the wording of the particular resolutions varied, but they all basically asked companies to report on the business impact of climate change. And so you can see in every case, it's gone up by quite a substantial margin. There's a mixture of companies on there, but the oil and gas companies would be Occidental, ExxonMobil, and Devon. And the other important thing to note about the behavior of a lot of investors, did notice that a lot of investors will always vote with management recommendations, but there are some investors, so for example, BlackRock and Vanguard, who voted against management in favor of climate resolutions for the very first time in their history. The criticism that people have put towards them, and I suppose ShareAction would as well, is that they've got a pretty inconsistent response. So they vote for climate resolutions in some instances and not in others. So it's kind of a mixed point of view. And they say that in some cases, they just prefer to have the dialogue with the company rather than vote against the management. So that's how they're justifying that at the moment. There are other investors which have made huge leaps towards voting towards climate resolutions, including Fidelity and Goldman Sachs. So we've seen a massive increase in support there. So that was kind of the information I wanted to put in the room, and then I just wanted to end on a reflection. So I wanted to mention why we might ask companies to report the risk of climate change to their business. So I don't think that anybody really believes that they're going to give you a fair assessment of the risk, because they're the people that stand to lose the most. So they're always going to downplay the risk. And we should always look to outside folks to do a more balanced assessment, possibly. But I think it's more about getting the conversation started and getting them to start to acknowledge the risk. Because I think when you're in the industry, there's a tendency just not to think about it and not to look at it, because it is such a kind of contentious issue, and you do tend to downplay the risks in your own mind. And so I think, then we also have to ask the question, what decision-useful information do investors require, so that we can make kind of the assessment of risk on our own behalf. And I think some of that is just very simple questions about, what production profiles and therefore carbon emissions are companies locked into? So what infrastructure do they already own? And every year they announce that they have kind of 6 to 7 major projects that they've delivered on time and on budget. And for every big major project, that will equate to large volume of carbon emissions. So all of the things that they talk about as being really positive in their business model kind of get flipped around, and from a climate point of view, become a risk. So I think we just need to ask them for kind of the data, and then we can do the assessment. And then in terms of labeling companies good, bad, or ugly, I was nervous to do that. I think by labeling them bad, I'm worried. I just feel like I've given up hope on them. And personally, I haven't. I feel like they could transform. But I think, the longer they don't, the less I have hope for that. And so I don't want to label them bad, but I wouldn't label them good either, because none of them are doing enough to meet the goals of Paris. Thank you.
Okay, so I'm not Geoffrey Supran. He's cooler than me. I'm like the American Midwestern version of Geoffrey, which is kind of like saying the same thing, that he's cooler than me. But he is a good friend of mine, and so I usually know what he's thinking. And so I'm going to give his presentation. He's been doing really interesting work on analyzing the 2-degree reports given by oil companies in this case. And so you might have seen this paper that he wrote with Naomi Oreskes from Harvard about a year ago. This is where they assessed ExxonMobil's climate change communications. How many people saw this paper? Raise your hand if you saw it. Okay, that's almost everybody. Okay, if Geoffrey sees this recording later, then you're welcome, Geoffrey, for me surveying the audience. Okay, anyway, so what Geoffrey and Naomi did in this paper was really interesting and quite illuminating, and it's contained in this slide here. But I don't want us to get overwhelmed by it. The take-home message is that by looking at ExxonMobil's communications about climate change, their internal communications, which are over here on the left, their peer-reviewed publications. Sorry, I'll stand over here so I don't get feedback. Right there. Non-peer-reviewed publications, and then advertorials, which were paid advertisements that look like editorials in the New York Times that ExxonMobil took out weekly for many years. And then categorizing each document in terms of, does this document acknowledge that climate change is real and human-caused, and basic things like that. So that's the blue, if they acknowledge it. And if they don't, if they express doubt about it, then it's red. So the basic trend you can see is that their private, internal communications mostly express acknowledgement of climate change. And the more public their communications were, the more doubt they expressed about climate change. And so their advertorials, about 80% of them expressed doubt, whereas about 80% of their internal or peer-reviewed documents acknowledge the existence of climate change. So this indicates that there's a disparity or an inconsistency between the way ExxonMobil is talking about the issue internally or to other scientists, as opposed to how they're talking about it to the general public. Okay, so some people might call this deception, but you can, whatever word you want. I'm just asking questions. Okay, so that's sort of the starting point, and if we think about these 2-degree reports from oil companies in a similar way, we might ask a similar question. So are their climate statements and their pledges in their reports consistent with the other things that they do? And this is the question that Geoffrey is trying to answer. And so he applies a similar methodology to try to answer this question. He looked at a couple different areas. One, the public communication of those companies, and also their policy engagement. So just for today, I'm just going to talk about the report from ExxonMobil and the report from Shell. And here's how the methodology works. So just considering the question, is climate change real and human-caused, does each of these 2-degree reports explicitly acknowledge that? Do they acknowledge it just implicitly? Are they neutral? Do they doubt it implicitly, or do they explicitly doubt that? So right now we're just talking about, is climate change real and human-caused? And so first looking at ExxonMobil, here there's language that is mostly implicit rather than explicit, and here's an example of that. So ExxonMobil says that they will address the risks of climate change by mitigating greenhouse gas emissions. Okay. Now, as somebody myself who studies the strategic use of rhetoric by polluting industries, I can tell you that just like a gallon of gasoline is highly engineered, that this phrase is also highly engineered. And in fact, it's engineered in every word. So you might think about the word address instead of halt, stop, attack. Okay, you're just addressing. Risks instead of harms or damage. Mitigating instead of halt or reduce or draw down. And greenhouse gas emissions instead of fossil fuels. So there's different ways you could write that. Jeff, that's just me just editorializing on this. Okay, but this risk rhetoric is really dominant. And Geoffrey found that it's almost always used by ExxonMobil, the description of climate change as a risk. So not necessarily even acknowledging it as real, but that there's a risk of climate change. And that the typical pattern is emphasize the risk, then switch to mitigation. Okay, this is the rhetorical pattern. And Steve Cole, you might have seen or read his book, Private Empire, about ExxonMobil. He says that this rhetorical twist or approach, it's consistent with an effort to reposition ExxonMobil's arguments about warming to more fully account for consensus scientific opinion without admitting that any of the corporation's previous positions had been mistaken, for that might open a door to lawsuits. So this is just his take on how this rhetoric can be used, essentially very broad risk rhetoric, to basically say, okay, we acknowledge the risk, so we weren't lying about anything, we weren't deceiving about anything. Okay. And actually, Geoffrey looked a little bit farther back into the rhetoric used by ExxonMobil. About a decade ago, you've got many forms of rhetoric. You've got complexification rhetoric, which again is really common in the product defense industry and to reduce legal liability. You have uncertainty rhetoric. Extent to which recent temperature changes can be attributed to greenhouse gas increases remains uncertain. And then you have alternative culprits rhetoric, like significant natural variability, putting attention onto that. Here's just another example. So ExxonMobil was asked by someone online, why won't ExxonMobil recognize that climate change is real and take actions to support the Kyoto Protocol? And so ExxonMobil says, we recognize the risk of climate change and its potential impact, So it's just an example. I just want you to get a feel for that, of how the risk rhetoric is used. It's a way to sort of acknowledge climate change without actually acknowledging its reality. And furthermore, this is also used, I'm editorializing again, by the tobacco industry in court, because risk is something that the consumer assumes rather than the industry putting on you. And harm is something the industry would do to you. So in court, the industry always talks about risk because it puts the focus on the consumer, and so it's their fault if something bad happened. Whereas usually, if you're attacking the industry, you talk about damage and harm because that's something that the product did to you. So this is actually very typical. Okay, and I think what Geoffrey found was that over time, ExxonMobil has shifted away from some of this uncertainty rhetoric to more of really leaning heavily on this risk rhetoric of managing risk. Okay, anyway, to get back to this, ExxonMobil doesn't mention net zero greenhouse gas emissions in its report. It just talks about the risks of climate change. And so in this case, sorry, that block is tiny, but that's green, and in case you couldn't tell, that's light green, not dark green, which corresponds to an implicit acknowledgement of climate change in its report. Okay, let's do the same thing with Shell. We'll go a little faster though. Okay, Shell mentions net zero emissions and more explicitly says things like surface temperature warming is directly related to the cumulative total of carbon dioxide emitted to the atmosphere. So it's a more explicit acknowledgement of the reality of climate change and its causal connection to their product. Okay, so Shell gets a dark green because they're explicitly acknowledging this. Okay. So let's compare that to the other things that these companies are doing and just see if they're consistent or if they're not. So one thing we'll compare is the scientific statements other than the ones in these 2-degree reports, whether those statements are accurate. We'll look at the affiliations of those companies, such as their membership in trade associations, many of which promote disinformation or fight climate policy. Oversight mechanisms for their own sort of information or disinformation about climate change as companies. Support for shareholder resolutions on climate. Disclosure of affiliations with trade associations. So are they actually saying what groups they're part of? And then finally, are they actively renouncing past disinformation that they've taken part in or not? Okay. So I'll just let this fill in. Okay, so you see a lot of red over here. And so Geoffrey here is looking at these different categories, and he's taking information from the Union of Concerned Scientists scorecard in these different categories and then transferring it over to his explicit, implicit, neutral, or implicit doubt or explicit doubt sort of buckets. Okay, and so this is what he gets. And so you can see again, this is sort of like an analogy to his ExxonMobil document paper, asking is their public communication consistent with the private communication? And here he's asking, are their 2-degree reports consistent with what else they're doing? And I don't want to speak for Geoffrey, but there's a lot of red on this side and there's a lot of green on that side. Okay. So here the take-home message is that this methodology is broadening the scope of how we can study and assess and scrutinize these 2-degree assessments, not just saying, are these companies complying with what they're supposed to do, but do their reports make sense scientifically? From a social science standpoint, are they consistent with what else they're doing out there in the political arena and in the communications arena? And really, what kind of legal liability, I guess you might call it, might that entail, that difference? And And finally, all of these things have to do with the company's social and the industry's social license to operate. I know that phrase is thrown around a lot, and it's quite vague sometimes, but really it's quite important because that's what we mean, or we mean this when we're talking about public opinion, public policy, and also litigation too, and it influences all those things. So I think this work is really important, and thanks for letting me sub in for that. So, thanks.
So I'm Myles Allen. I'm very happy to talk on this panel, and thanks to Peter for inviting me. I wanted to talk really to this social license to operate question, and picking up on a couple of points that have already been introduced by the previous speakers. In fact, this one fits very nicely with Geoffrey's / Ben's talk. Just picking an example of current reporting practice from, sorry, we're all seem to be picking on Exxon, but it's an easy target. They have broad shoulders. This is one of the figures from that energy and carbon summary, which which thanks to ShareAction, they were had their arms twisted into producing a couple of years ago. Well, years ago. So this is sort of typical information that we're asking for. And the companies are, in some cases grudgingly, in some cases willingly providing it. And the crucial point here, and the message of their response was, look, that's the baseline, that's sort of like business as usual. Here are the 2-degree scenarios or the below 2-degree scenarios. Here's Exxon's scope 1, scope 3, scope 2, scope 3 emissions. So look, we're kind of in the ballpark. We're following the 2-degree scenario. We're good, and that was essentially the message of that. And as Ben just pointed out, the one thing they didn't mention at all in this report was what happens next. And they certainly didn't mention net zero and the overall trajectory. Shell in their Sky scenario certainly go further. They talk about net zero. They talk about the technologies that will be required to get to net zero. They talk about the massive increase in CCS and negative emissions that will be required in the 2040s onwards in order to achieve net zero. They spectacularly don't talk about who's going to pay for it, which is the big gap in that narrative, certainly for me. So this was a success. If that's success, and I don't want to belittle the steps we're making. On the other hand, we need so much more information. And it's not just we need more information, we need different information from these companies. Because just to know that a company is sort of somewhere inside the IEA 2DS scenario out to 2030 or so doesn't help us at all. It might well, these companies are making investments, they're buying kit, which will still be in use out in the second half of this century. And what their plans are to 2030 or 2035 are to some extent neither here nor there. So what are the questions we could be asking these companies that would be much more relevant to the long-term prospects of actually achieving the goals of the Paris Agreement, of actually achieving net zero? So can I just take exactly the same series and put them into context? So these are those assessed 2-degree scenarios, rather more of them, showing, this is just the IPCC Fifth Assessment Reports, well below 2-degree scenarios. Ignore the sort of couple of outliers here. The big bundle following down towards negative emissions sometime in the second half of this century. These have been colored, by the way, by the mitigation cost per year in each of these scenarios. And notice a very broad range of colors, particularly in the second half of the century. I'll tell you what the colors actually mean in absolute terms in a minute. This is just a different way of plotting exactly the same scenarios, okay? This shows you a very familiar plot of emissions as a function of time. This shows you the fraction of carbon we stuff back down underground in these scenarios as a fraction of the total amount of carbon we dig up. Very obviously, they cross the grey line at exactly the same time, because you get to net zero when this fraction equals 100%. Yeah? That's not a statement about any technology. In these scenarios, that fraction is achieved solely by CCS and BECCS, because simply these are run with integrated assessment models which don't have anything else. If I had to make a prediction, I'd say very confidently, it won't be done with nothing but CCS and BECCS. There'll be many other technologies in there as well. But the fundamental geophysical point that to get to net zero, you have to be putting carbon away at the same rate you're digging it up, stands, regardless of what technology you're interested in. I was depressed this morning that the only mention of CO2 disposal was in the context of a joke. And that's, I think, a problem, because a lot of our disclosure requests to these companies are not really addressing how these companies are going to play a role themselves in the transition to net zero. What's interesting, sort of a side, but an important side message of this figure, is it sorts out this bundle of spaghetti into expensive ones and not quite so eye-wateringly expensive ones. And the really expensive ones, the ones in which climate mitigation is costing the value of the world economy today every year in the latter part of this century, are the ones where we delay deployment of CO2 disposal. If we don't develop the technologies to get rid of CO2 early enough, climate mitigation is going to be eye-wateringly expensive. That's the message of these scenarios. There is one new sort of wildcard scenario out there, the low energy demand scenario, which came out earlier this year, which purports to do all this without any CO2 disposal at all, largely by reducing energy demand by the order of 50% by 2030. Okay? So I acknowledge that scenario exists for the purposes of this, but it's also not a scenario that's considered in any corporate reporting. So no corporate report that I know of has benchmarked itself against the new low energy demand scenario, and I doubt that any fossil fuel company would be particularly interested in doing so. So the problem is that we know exactly where we need to get to. We need to get 100% sequestration. We know exactly we know exactly what needs to be done. We haven't even started the conversation about who's going to pay for it. So this is the fundamental point I want to make about for you to think about. The idea that sort of we're sort of somewhere inside the scenarios is not enough if you're dealing with a company that's making very long-term capital investments that are relevant to emissions in the second half of this century. This is just a simple statement of fact that if we want to get to 2 degrees, the fraction of carbon that's permanently sequestered has to increase on average by 10% per tenth of a degree from now on. That's not a policy, not a scenario, it's just a statement of fact. If we want to get to net zero in time, we're at 1 degree now, in case anybody didn't know that, so therefore we've got 10/10ths of a degree to continue forwards, therefore we've got 10 steps in which we have, over all of them, to increase the fraction we sequester by 10%. Okay? If we assume, if we want to limit warming to 1.5 degrees, we have to increase it by 20% per tenth of a degree. A tenth of a degree of warming takes about 7 years or so. Okay? So that's what it would take if we were going to increase this fraction in a straight line. We would need to be at 40% sequestration by 2030. Now, a company might reasonably argue, okay, wait a minute, if we're going to start now, it'll get easier as we go along, so it makes sense to adopt another profile. And I would say, fine, tell us your profile. Pick a quadratic profile, okay? So you're going to flatline now, and then you're going up like that, but you've still got to get to 100% if you're going to say you're consistent with Paris, okay? Adopt a quadratic profile, they need 16% sequestration by 2030. They actually could do that, and that's what's frustrating about this, is that if companies actually wanted to and felt they needed to as part of their license to operate, these guys could easily be at 16% sequestration by the early 2030s. A lot of that CO2 could come from their own emissions. The crucial point is that even if they passed on the entire cost of these measures to their consumers and had no impact whatsoever on their bottom line or return to shareholders, the cost would be far lower in the short term than the kind of carbon taxes that are being talked about, the carbon prices that are being talked about to achieve these well below 2-degree scenarios. So this is a way of, this sort of upstream approach is a way of turning climate policy on its head and opening up a whole new set of questions about who should be paying for what and how we can achieve our goals. I wanted to draw your attention to these. They're out in the foyer. Earlier this year, I think I was on one of Peter's slides of things that have been happening in this area. We published an Nature Climate Change article, which is that we've got a policy brief about, sort of suggesting much simpler questions that activist investors could be asking companies to reveal what their true plans are relevant to the Paris Climate Agreement. We're increasingly frustrated as academics seeing the amount of mental energy that's being invested in this question and answer process, sending companies questionnaires to get them to, and scoring them on increasingly complicated score charts, which just don't ask the main question. So we were depressed, for example, that the Church of England has now adopted the Transition Pathways Initiative. Again, I was picking on ExxonMobil now, so now I'm going to pick on one of the good guys, so I'm sort of being even-handed. Transition Pathways Initiatives the Transition Pathways Initiative is probably one of the best in kind shareholder initiatives to engage with the fossil fuel industry. They ask companies 17 questions about the management relating to climate change. They mention net zero the same number of times that ExxonMobil does. Okay, so we've got a problem here. And when pushed, many of these shareholders, so this is not a reference to TPI, but another one, when I pressed them on why they weren't asking about net zero, the answer was, very depressingly, because they wanted to maximize the number of assets under management that signed up to their principles, and they knew that that answer would be that number would be zero if they insisted on net zero. I was like, well, if you're not asking the main question, then what's the point of what you're doing? So I think that the shareholder activist industry, and it's building up as an industry, needs to simplify what it's asking and focus it on what we actually need to do. I wasn't keeping track of my time, so I'm sure I've run out of time by this stage. Yeah, thanks, Peter. Okay, and those are just the 3 questions that we think many of these myriad questionnaires could be distilled down to, and it would be really helpful to think about how we could simplify those things in that way. Thank you.
All right, so I and the Q&A and discussion are standing between you and reception. So thanks a lot for the opportunity to add to this discussion, and I'm looking forward to elaborating on some of the increased demands for disclosure of climate risks, but then to preview some of the findings from UCS's forthcoming climate accountability scorecard, and finally to offer a few ideas about what shareholders, policymakers, and others should be demanding of major investor-owned fossil energy companies at this time. So, oops, now I get it. No, I don't. No. All right. You said the back left, huh? All right, I will just use this, yes. Great, okay. So, and I'll go the right way. So with the adoption of the temperature targets in the Paris Climate Agreement, the clock really started ticking for major investor-owned fossil fuel companies. We heard a bit from Joe about the increasing demands from institutional investors. And I also am going to use ExxonMobil as an illustration of how these companies responded. So this is before the adoption of the Paris Agreement, what ExxonMobil's projected trajectory for energy-related carbon dioxide emissions was. And this is what it looked like in 2018 after the adoption of the Paris Agreement in its 2018 Outlook for Energy, similar to the graph that Myles showed. So, and a shout out to Jonathan Strauch for that update to the graph that Peter Frumhoff and Naomi Oreskes and Rick Heady produced in a paper in 2015. So, as we can see here, there is the company is foreseeing no reduction in emissions from the energy sector through 2040, and as Myles noted, it's not going to net zero at any time. And this is because ExxonMobil is really counting on natural gas to fulfill the growing demand for energy that it foresees. So this, as we've heard, only came in response to a shareholder rebellion in a vote by a 2-to-1 margin that included major firms, major investment firms like BlackRock, Fidelity, and Vanguard voting in favor. And so I guess what we've seen really is that these resolutions against these resolutions for similar to the one that passed at ExxonMobil have gone before 19 of the carbon majors identified by Rick Heady since the Paris Climate Agreement passed. And they have, on average, received support of 40% of shareholders, which we heard from Joe is significant. And they've helped lead to the publication of 9 so-called 2C reports by these companies. So we see really that this pressure is mounting. It's mounting for mainly financial risk disclosure, so more about the risk to the company than to our climate and our society. And it really is in the realm of transparency versus transition plan. And so we at UCS really believe that this disclosure is necessary, but it's not sufficient. And so in our work to hold major fossil fuel companies accountable for their outsized role in climate change, we've really sought to assess not only their positions, but also their actions. And what I'm going to do is talk a little bit about an update to our climate accountability scorecard, which was originally published in 2016, and asked and really took this question, which again was posed in the paper that I mentioned earlier, with these broad answers about expectations for what major fossil energy companies, how they ought to operate in a carbon-constrained world. And we translated those expectations into metrics and actually have defined and scored 28 metrics this year across the first 4 of these areas. We're not yet in a position to assess how companies are paying the costs of climate damages and adaptation because none of them has yet started to do so. So I'm going to highlight a few findings from the updated report that's coming out next month. And these are 3 areas that are particularly salient to interpreting and understanding these 2C reports by major oil, gas, and major oil and gas companies. And they help to illustrate the gaps and limitations in the reports that we've seen to date. So first, how are they aligning their own business models with net zero emissions? We've already heard a bit from Myles on that point. To what extent are they directly supporting Paris-aligned public policies? And how well do they ensure that business groups that are lobbying on their behalf actually support their stated positions on climate change? So as in 2016, we studied 8 investor-owned fossil energy companies, and thanks to Rick Heady's pioneering work, we know that these 8 companies have contributed about 14% of global energy-related carbon dioxide and methane emissions that are driving disruptive climate change. First, let's dive into the question of how well these 8 companies are aligning their own business models with the Paris temperature target and net zero emissions. So the oil and gas companies in our sample have made headlines since Paris, in some cases for pledges to reduce emissions or invest in renewable energy, in other cases for asserting that they can continue to profit from extracting fossil fuels. But the reality is that none of these companies has set a company-wide net zero emissions target that's consistent with the Paris Climate Agreement's global temperature goal. And we've heard that, despite the fanfare about Shell's Sky scenario, for example, it relies on a 200-fold increase in the deployment of carbon capture and storage by 2050 without revealing a coherent plan for how that would be paid for and achieved, as Myles has pointed out. Let's now consider whether and to what extent these companies are actively advocating for implementation of the Paris Climate Agreement. How are they looking for policies that will put in place a level playing field for all companies across the energy sector? So by and large, the fossil energy industry was late to come to the Paris party. But now, nearly 3 years after the adoption of the agreement, all 5 of the oil and gas companies in our sample have made claims to support policies or regulations to advance the Paris Agreement. However, only Shell explicitly supported its global temperature goal and the net zero emissions target in connection with policies to advance and implement the agreement. So finally, let's review how well these companies ensure that business groups that they pay to lobby on their behalf actually take positions that are consistent with the company's own stated positions on climate change. And there's good reason to be skeptical of any of the statements by these companies in this area. As UCS and others have documented, major fossil energy companies have a long history of funding campaigns to sow doubt about climate change. Much of this disinformation has been disseminated through groups like the American Petroleum Institute, the National Association of Manufacturers, and the US Chamber of Commerce. So API, we know, has a long history of communicating climate science disinformation. The now notorious 1998 memo that laid out a roadmap for essentially casting doubt deliberately on public understanding of climate science. But it isn't only in the past. The 2017 Climate Change and Energy Primer of API blatantly omits the need to reduce global warming emissions, the risks of burning fossil fuels, and the science of climate change. Just to take another example, the National Association of Manufacturers, which years ago housed the Global Climate Coalition, in 2017 was responsible for launching the quite ironically named Manufacturers Accountability Project, which is actually seeking to discredit the municipalities in the US that have filed lawsuits seeking to hold the fossil energy companies accountable for climate damages. So all 8 companies in our sample maintain membership in trade associations and industry groups that spread disinformation about climate science and seek to block climate action. And each of these companies holds at least one leadership position in such a group. So in order to ensure that well below 2C reporting by major fossil fuel companies is meaningful, consistent, and comparable, and not a vehicle for greenwashing, now is really a critical moment to clarify our standards and expectations. And shareholder resolutions ahead of the next round of oil and gas company 2C reports are a great opportunity to do that. So then another set of pretty simple expectations that we could put out to these companies to set a company-wide net zero emissions target consistent with the Paris temperature goal, publicly and consistently advocate for policies that will implement the Paris Agreement, and disavow, break from positions and actions that are taken by affiliated third parties like trade and industry groups. So those shareholders who are not satisfied with the reports they've seen to date should consider using the shareholder resolution process to put these kinds of demands in front of the companies. Investors really need to be considering what their threshold is for maintaining investments in the fossil energy industry. And we've heard some great information here about the growth of the divestment movement. One interesting example is Barnard College, which in 2017 decided to divest from fossil fuel companies that deny climate science. And they were informed by the by the UCS scorecard in doing that, and we've now collaborated with them and with fossil-free indexes in the analysis to back up implementation of that decision. So we also need to be looking at how standard setters like the Sustainable Accounting Standards Board, CDP, and the Task Force on Climate-Related Financial Disclosures can integrate these kinds of demands, and how ultimately policymakers codify them as how climate risk should be disclosed. So I want to leave you with the question, what if we didn't let fossil energy companies set the terms of well below 2C reporting and planning? And I believe that we'd start to see better disclosures, we would see more ambition, and most importantly, we'd have more near-term action. Thanks.
Thank you. Just in terms of, this is a question to any of you actually, in terms of a strategy for engaging investors, when do we move from being investors making resolutions about corporate reporting to disinvestment? So if 98% of the shareholders at a BP meeting in 2015 had handed back their shares, or if BlackRock actually took their equity funds out of fossil fuel companies, wouldn't that have a greater impact than making resolutions about reporting? So I guess the question is, are we just sort of in a situation now where investors are passing the guilt or the responsibility over to the fossil fuel companies for actions that they could or should be taking themselves?
Richard Heady, Climate Accountability Institute. Fantastic presentations, all of you. A quick question for Sophie first. CEOs or some other senior manager has to sign the 10Ks in the annual reports, and I'm wondering if there's any personal leverage with their signatures on the bottom of those kinds of statements or misstatements. And a question for the broad audience, for the broader panel. I'm wondering if we can operationalize the threat of social license to operate in some way, and what might be the pathway.
Hi, Megan Darby, Climate Home News. I just wanted to pick up on what Myles said about shareholder activists don't mention net zero to avoid alienating investors. And I just wanted to ask Joe whether that's your experience of talking to investors and whether that's something that is discussed in ShareAction and in your network. And also perhaps Sophie, if because net zero is also a goal of the Paris Agreement, and whether there's any sort of legal leverage around that goal.
So who wants to go first here? Go ahead, Joe. Yeah.
I suppose going back to the divestment versus engagement question. Can you hear me? Yes. Okay. Brilliant. So that's a very live conversation in ShareAction about divestment versus engagement, and we fall on the engagement side at the moment. So I think if everybody agreed to divest their shares in big fossil fuel and carbon-intensive companies, that theory of change would work brilliantly. But the nervousness is that if the responsible investors that care about this stuff divest, there aren't enough other people willing to also divest, and they'll just absorb their shares. So at the moment, it doesn't feel like there's enough people willing to totally divest to make that work. It doesn't mean it couldn't happen if this comes to a real crunch point in the future. So at the moment, we recommend that people that hold shares in companies and care really keep this conversation live. It seems like the best option for now. That's all I've got.
Just to add on to that, I mean, we definitely see it as a continuum, and so one option is to look at really leveraging the threat of divestment with those companies that fail to meet these expectations, but not reducing the expectations to something that they're willing to meet. There's certainly a lot of power in the socially responsible investing community. There are having some of the major investment firms actually take these factors into consideration is leverage that we need to figure out how to mobilize, while also making strong moral and ethical, and in Barnard College's case also just academic mission arguments against disinformation.
I think on the license to operate question, I think for that to get onto the table, we need to have much clearer asks about what we really want these companies to do. I was involved in a court case earlier this year, the cities of San Francisco and Oakland against various fossil fuel companies, and I was only involved to provide the court with advice on the science. But in the course of this sort of science tutorial that we held, which was a very interesting experience for me at least, and I think many other people as well, the court asked a really interesting question, not of me, I was off the stand fortunately at that stage, well, what else could we have done, talking about the companies back in the 1980s, and the conversation sort of rapidly moved off onto nuclear energy and, you know, the usual suspects about alternatives. And I was, unfortunately, with the sort of the way American courtrooms work, it's all very organized, and you certainly can't speak out of turn and anything like that. And I was sitting there seething because, you know, if it had been an academic situation, I'd have had my hand up saying, no, I've got a contribution to make here, because I couldn't do that. And the reason it was obvious was because the defense, Chevron's lawyer, had mentioned CCS. Every time they talked about mitigation, they said, for example, CCS. It was like it was clearly programmed language. If they mentioned mitigation, they had to say, for example, CCS. And it was quite interesting actually, because after a while it got a bit like, hey, this is weird. Why is he saying this all the time? So the point was, they had clearly acknowledged this was a mitigation measure that could be taken. It was a mitigation measure that was out there, available in the 1980s, and it was a mitigation measure they hadn't invested in. So that was a golden opportunity for somebody to say to the court, yeah, they could have done something different. They could have been investing in CCS, and they chose not to. And that's something that wouldn't have affected their bottom line significantly, and wouldn't have affected their overall business model, and would have given them by now a coherent story to tell about how they could transition to a net zero fossil fuel company. You know, why should there not be a net zero fossil fuel company if they could do it? Many people are very skeptical about whether that sort of large-scale CO2 disposal is ever going to work. But surely, if we say it won't work, then we excuse the companies from the obligation to demonstrate that it will. There's some shaking heads already in the room. But the point is, we're letting them off the hook by saying it's impossible.
So, thank you, Myles. I'm going to make sure we've got time for one more round of questions. I've been given marching orders to end this at 6:25. I'm going to try to live into that. So let's take 3 more questions to as many different panelists as possible. So go ahead.
Is it me first? Okay, Mark Campanelli, Carbon Tracker. I've got a question for Myles. I was in San Francisco, GCAS, and the investor agenda met. It's the Climate Action 100. They've got $32 trillion have lined up to deal with climate action, to take on the world's biggest polluters. You're probably familiar with what they're trying to do. They're giving it 5 years. Now, the analysis that they're using is using the Transitions Pathway Initiative analysis, and you've just kind of thrown a bit of a bomb in that direction. Do you really have serious concerns about it? Because if you do, that really undermines the whole basis of how CA 100 is going to work.
Yes, I have very serious concerns, and I've spoken enough.
Hi, Ipek Gençsu, Overseas Development Institute. My question is to Ben, but the rest of the panel as well. It was very interesting to hear your insights about the use of words like risk and mitigation, but I'm afraid I'm probably guilty of using them, and many others in this room as well. So I wonder whether we need to have a conversation during these couple of days about our rhetoric and which words we use and in which ways going forward, because it is a complex situation, another word that you criticized, but I feel like at least we can start being aligned on it, and then we can criticize others.
Thank you for that. Let's take another question.
Hi, my name is Nico Bauer. I have a question to the more activists on the panel. I was wondering that you put so much emphasis on oil and gas. And when we look at the scenarios of these IAM models, and I have to admit that I'm guilty of producing some of those scenarios, so somebody has any questions or so. The thing that we see is coal has to be moved out quickly and first and pervasively. Oil and gas, not so much. It is mainly coal, and coal is the dirtiest. It is the cheapest, so least valuable, and the industry as such is also the weakest. I mean, if you go against Chevron and others, they might be much more powerful. And I wonder, why do you put so much priority on oil and gas and so less on coal?
So Ben, you want to take the first?
Yeah, so I'll say some things. Yeah, thanks for your question. It is really important. It's the power of rhetoric. Maybe we sort of underplay it because it's a little bit amorphous as a concept sometimes, but it's actually extremely powerful. And that's why many companies have spent a lot of money through PR firms to hone the rhetoric and control the language that's used to talk about things. And generally what many industries try to do, industries that are regulated or on the defensive, is they use language that puts the agency away from them, because they lose when the focus is on them. So they put the agency on the consumer and on governments and pretty much anything else except for them. And so the tobacco industry did that with smoking. We don't talk about tobacco a lot. We talk about smoking a lot. And they use the risk rhetoric too, risk instead of harm, right? Because the risk puts the agency again on the consumer, in addition to being kind of an amorphous concept. So that's just a little bit, but it's a highly developed area, and it's worth billions of dollars because that's how lawsuits are won and lost with that language. And so you're right that the research community has internalized a lot of that language. We love to talk about how complex climate change is, when I would argue actually it's not that complex, because anything is as complex as you want to make it. Thank you. And so, yeah, the research community has internalized a lot of that language too, and it's, we definitely need to be aware of that and make new language. And then I just want to maybe throw my 2 cents in for how do we operationalize the revocation of the social license to operate. And I would say 1 is sue them. 2, take away their sponsorship deals and their ability to advertise through strategic philanthropy. That's very important for them. And take away their ability to recruit. Those are just 3 ideas. Maybe they're too draconian, but if you look at through history how that actually happens, and I think tobacco is just such a great example. It's such a great analogy for learning things. That's how the tobacco industry lost its social license to operate too. It is a complex phenomenon how that happens, but I think we can learn a lot by looking at past examples of where that has happened.
Thank you, Ben. Just quickly on the question about coal, if coal companies were writing reports in response to shareholder or other pressure about the 2-degree target in line with their support for Paris, we'd be evaluating them in this conversation. The fact is that they're not. It doesn't mean that driving coal out of business in its current form isn't important. It's an essential for the reasons you highlighted, but we're not going to get to net zero without getting rid of the emissions that are currently going to the atmosphere from oil and gas as well. So it's both and, but this particular panel is focused on a particular set of the issues and therefore looking at a set, not all of the oil and gas companies. We just have a minute or 2 left, and I wanted to see if any of our panelists, perhaps someone who hasn't spoken yet, wants to make a final observation, comment, add their perspective into the mix.
Sure. I had 2 sort of legal questions noted down, so I'll just try and quickly respond to those. I think, Rick, you asked about whether the personal liability was relevant if executives sign off on annual disclosures. Yes, absolutely, that's the case. And in the Ramirez case, several executives and ex-executives of ExxonMobil have been implicated directly in that decision and in that fraud, alleged fraud, including Rex Tillerson. And that was, the court found that they had the requisite, that the claimants had met out the requisite intent to deceive, because the company neglected to debook many huge quantities of reserves until after it had implemented a share buyback scheme. And after it debooked those reserves, its credit rating was downgraded. So the court found that that showed the intention to deceive and a motivation to deceive on the part of the executives. And the second legal question, I think Megan asked, is there legal leverage around the net zero and the goals of the Paris Agreement? I think that there is, but to be brutally honest as well about what investors think and are doing, I think many investors and actors, when they say, yes, we're committed to the goal, and companies as well, we're committed to the goals of the Paris Agreement, but nobody really knows what that means. They don't know that that means net zero by somewhere between 2040 and 2060. They don't understand what a net zero economy really entails, and so there's a lot of high-level commitment to the Paris Agreement, but then when you dig down into that, well, what does that really mean? There's a lot of failure to, I think, to face up to the reality of that.
And on that note, thanks everybody for joining us.